What's going on, guys? Standard back at it again for episode 2 of the series. I probably will be calling this support and resistance. And just finding levels, really. That's going to be what we're going over today. So, a brief overview before you hop into the video. We talked about price action, identifying a trend, identifying a consolidation period, identifying a breakout, and identifying a trend reversal. So if you don't already know that, go back to the last video, take some notes, look at some charts online, and then come back to here we are now. Alright, so today we're going to be talking about support, resistance, aka supply and demand. We're going to be talking about support and resistance flip, and we're going to talk about simplifying the overall information that we learned today. So since we were talking about these stocks prior, I think it'll probably be easier if I go back to them and refer to them once again. And we're just going to be creating a few levels here. So let me get rid of all of these. We're just going to be going over support and resistance real quick. So let me back that out. There we go. Okay. So support and resistance. Support, think of it when you're, building a house. You have pieces of wood supporting the house, hold itself up. The concrete or sub-base to the house holds the property up. It supports it, like a bridge supports cars. It holds it up. It's holding something up. It's below something. That's what you really need to know. So if we were to have a consolidation period, get used to the boxes, because you're going to be using them just as I do for the trading strategy in the future. As we can see here in the box, in the consolidation period, there is a top and a bottom. So on the bottom, that would be the support. It's holding it up. It's keeping it strong. Now, what is a resistance? Think of it as if you're maybe arm wrestling somebody or trying to push something open, and it's hard to do as such. It's giving you resistance. It's not easy to break through, to go through. So it's holding you back. It's holding you down. That is going to be on top. That is resistance. So let me label that resistance and support. So that's just the basic. If you need to draw yourself multiple examples, go for it. But just literally all you need to know is the bottom half of a consolidation period is support, and the top half of a consolidation period is the resistance. As we can see here, labeled the tan lines, and the consolidation period is overall in the middle, and we're just looking at the top and the bottom. So with that being said, we are going to be looking at Western Digital Company, and we're going to be finding some support and resistance. So as we can see here on the bottom of this square which we know is the consolidation period, the bottom is going to be support, just as over here, support, and the top of this square is going to be resistance. The top of the consolidation period, or the square, is the resistance. So hopefully that makes some more sense. There's really not much to it besides that. I guess if you don't get yourself a perfect square, as we do have right here, there's not really that much of a square here. It's gonna be kind of hard to box this up. Like, yeah, you can do that, but it's pretty narrow and it just kind of curves around. So you would just be able to label the resistance, and so you'd place that at the top of the candlesticks, and then you would try to find some overall general bottom which is looking somewhat like right around here, and you would label that as the support. So this would be the support, this would be the resistance over on this side, and those are kind of your boundaries. That's where the consolidation is going to happen. Price is likely to stay in between those levels, and when it's not in between those levels, then it breaks out and it goes back into a trend, as we learned in the last video I uploaded. So that covers the first basis point of support and resistance. Now, supply and demand is the same exact thing. So demand is the same exact thing as support, and supply, is the same exact thing as resistance. So you can use them interchangeably. It's really up to you. I honestly don't even use either of them, and you're gonna see why within the next 5 minutes. So I used to love saying supply and demand, but I kind of just oversimplify things now for myself. Or not oversimplify, but simplify a lot what I normally use. So as we can see here, I have these gray boxes, and you might be wondering, why is it like, or at least this is what a lot of people say, why does everything look so digestible? Why is it so understandable when you're saying it? Why is it so understandable when I'm looking at your chart? Because I make it digestible for myself. It's not because there's some magic behind it. I just make everything into squares. I make everything into like 90-degree lines, and that makes it a lot more digestible. If I were to get rid of these squares, I mean, just look how crazy this looks, seriously. If you're not looking at any of these squares, what is even going on right here? I mean, seriously, close your eyes, 5 seconds, open them back up. You would have no, like, it would just look super complicated, and it wouldn't look like anything that could possibly be productive. So, with that being said, you need to learn how to simplify the equation, I guess you could say, or the charts, the information, I really should say, the data. You should be able to sift through the data and simplify it for yourself. So how do we do this? We create the boxes. And then obviously the top of the box and the bottom of the box are going to be the supply and demand, or the resistance and the support, respectively. So the box method. The box method, that's awesome. A lot of people really like this. So the idea is, obviously there's all of these candles right here, and there's a lot of highs and a lot of lows and a lot of in between. There's a lot of highs and a lot of lows and a lot of in between right here. Same thing over here. There's just like a lot of ups and downs and like rigids to it. But you can see like the consolidation and just the general idea that it's giving. So what you want to do is you just want to grab the rectangle and just put it around it in a square form. And it makes it so much easier to understand if you can give something a perfect 90-degree angle and like set boundary. It just makes everything much more digestible. So even over here, this might look complicated, but if you were to put a box around it, let's just look. Look at that. It's boxed up. Boxed up at a Monday on 9:13 p.m. Imagine that. It's that easy. You just learned. That's crazy. Here's another consolidation period we can look at. Where's this? Just box this up real quick. Boom. Boxed up. Look how easy it is. Look how digestible it is now. You can understand the top and the bottom and the general overall support and resistance, or supply and demand with this setup. And those are the lines you would want to look for the breakout and the trend to start. So yeah, you're basically just boxing the consolidation periods, and then if you want to, you can also box the trend periods. The only reason, honestly, why I box the trend periods is because it's easier for me to I mean, You might not want to learn this early on, but a lot of trades and or different stocks, they kind of will resemble one another at certain times. So if I see a certain stock look a certain way, I might think, oh, it looks a lot like maybe Western Digital. And so I'll give like the whole setup, like the whole tradable setup and outline, and then I'll go see if the other stock has the exact same or similar setup. And so that's what happened with CrowdStrike not too long ago. And it just looks very similar to me. And so I like to just kind of simplify it down and give myself this pattern, this consolidation middle box, this short bottom box consolidation, and then this breakout and run period at the end, the top right box that kind of goes up higher. That's the general gist of the boxes there. So the overall idea is to simplify, as I've said multiple times before, so hopefully that makes sense. Let's just go on a random stock. Apple here. Excuse me. So Apple's been trending. There's not much consolidation. And what are we going to want to do? We're going to want to get some levels. So we can see the most recent low. We can place a level there. And this level, which was rejected off of, we can place a level there. Now we can see the most recent, or the only spot above the current level that it rejected from was up here, and same with up here. So yeah, you could go and label the supports and the resistances, but what did I say before? When I was introducing the boxes and the overall labeling method, I said that I do not actually use either of the terms. I'm really just looking at consolidation and breakout. So how would I trade Apple? You're probably wondering. I wouldn't, because there's no consolidation and breakout for me to enter on. There's nothing I could do. So the idea is just to be patient. There's hundreds of stocks that could be traded, and there's so many different sectors, and there's so many stocks in different indices or indexes that have their runs, have their breakouts, have their consolidation periods. So it's important to practice patience and wait for the A+ setups. There's going to be always consolidation periods. So just understand that you're going to have to be patient. With Western Digital right now, there's not necessarily that much of a clear top and bottom here. So it's kind of hard to label the consolidation period, but I'm sure we'll eventually have a breakout or a breakout to a new area, and then it'll consolidate, and maybe it'll be more digestible and understandable. So that's what we're hoping for. But there's so many other things that we could trade that could provide us a much more viable setup where we can use the box method. So yeah, use the box method to simplify supply, demand, support, resistance, the box method. I don't know why I keep saying that, but it just sounds so good, the box method. I don't know. The idea is to simplify with the box method. That's why we're doing it. That's why I do it. I need to keep things as simple as possible. So, yeah, hopefully you do too. Put things in boxes. Now we need to go over flip. So, cat's going crazy. I don't even know where he is. He's somewhere hiding away in that shelf. But the overall idea here with this trade is, this is perfect. So, as we can see here, we have this line right here, which is support. So I'll label it support / demand. So as you can see, that's support as and or demand on the bottom half of the consolidation period, the bottom half of the box. And when we break below, so it's now the top. So let's just imagine we're looking at this. We would instead be below it. So when we're below something, whatever overhead would be the resistance and or supply. So the terms just flip. When you're below something, or when you're below a level that you labeled prior that was demand, it would then become supply. so you'd bounce down from it. And then you would have to find another label in the direction that the new trend was going. So, as you can see here, this resistance, or this support broke down and it turned into resistance because we were below it. And then eventually, as we'll see, we broke back above it. We broke above the resistance. We broke from below. We broke above it. And now that we were above it, it turned into support and or demand. So we were to bounce off it. So that's just a way to understand the levels and understand the flip and how it works. So yeah, the terms are constantly interchanging once you start to get into the trend periods, and then you'll bounce off of them in the other manner. So yeah, label your boxes so you know where the bottom support and resistance words would be, and where the lines are. Sorry, cat just went crazy, but he's cracked out right now. Anyways, okay, yeah, so I got all those done. Now onto the advanced stuff. So you could, if you are kind of over encumbered mentally right now, pause the video and then come back here another time. But I'm going to be talking about trend lines. So a trend line is most efficient when it's at a lower degree angle. So if you have a trend line that is anything like this, or like this, or like this, you don't really want to use that. You're looking for lower arched trend lines, just less degree, as close as flat as you can get. So that's the number one tip. Make sure to write that down. That's the most important thing I could say in relation to trend lines. Now, furthermore, what is a trend line specifically? It's just like a kind of general direction. And imagine you were able to angle this box. Angle this box so the top half of the box is up here, and you would have like a bottom half of the box down here. So it's just like that area between these two boxes was filled in. So you're just kind of like finding where that one of those lines is. So the general rule is if it touches it 3 times, then you can make yourself a nice line. So I had this line here on Caterpillar, or Cat today. Excuse me. And what do you know? It was a nice solid trend line. I made it after it touched 3 times. And we break out of, let me get a line here. We break out of this box. We break out of this box. We break through the resistance. We break through the trend line. And what do you know? We come back and we did the flip. Remember the flip. We come back, retest the resistance, which is now turned into support because we're above it. We retest this support, the top of the box, and the top of the trend line. So we did the flip, and we touched them from above now. So we flipped it, and we changed directions. And so that was the point of entry, and that was the trade I took actually today. So I guess if you're watching this in the future, and you care to think about, or if you're thinking about the future, and you care to think about what the trading strategy might be, this is a general idea that you can be looking at here. This is one of the plays that will be taken more often than not. So yeah, that's a little bit farther ahead, but hopefully that makes sense. And now, most importantly, if you are thinking really far ahead right now, and you are you're like, okay, this stuff is pretty basic, but I just want to watch standard videos and get some information. This is probably the most advanced thing I'll say, or this will be the most advanced thing I say in this video. You need to be able to anticipate. So every Sunday I go through and I make a watch list. Every Sunday night or evening. And obviously the charts aren't this far ahead at the time, but I was able to see, where's the rewind? There we go. So this is what I was looking at during this period of time. I was able to see that we were likely to break through this current resistance, and then break through, and then I was going to just trade the bounce after it was turned into support or demand. So should be able to go through, and what do you know, it breaks up, comes back down, retests it as support and as demand now, in the bottom of this box, or the top of this box as well, and then it goes up. So you need to be able to anticipate, you need to be able to think 2 to 3 to 4 to 5 days ahead, what is the most likely scenario to play out here? Because you want to be able to put things on your watch list when you go on Sunday night and look for possible setups for the weeks ahead, or for the week ahead, for the few days ahead. You want to be able to have like the top setups in mind that could possibly play out. So that's just a little bit of speculation that you need to be able to do. You have to speculate what the future holds, so that you can give yourself the best chances to win. Because if you're coming on here and you don't have a trade idea in your head and you just open up the chart and you think, oh, that looks good, I'm gonna enter a trade. No, that's way wrong. You need to be thinking about your trade idea much prior to when it's happening. Because if you're acting instinctively, or I guess you would say instinctively, right in the moment, that's just not good. Everything should be very robotic in nature. If this happens, then I do this. There should be no thinking in the moment. You should already know what is going to happen prior. You should be able to know what you're going to do, what the setup is going to look like, and you should only enter if the certain circumstances occur that you were planning on entering with. If you're just going through and like this happens to everyone who day trades, you're like, oh, dang, this setup looks great now, and then your bias quickly flips. You're not following some rigid schedule, or rigid rule set, then you just screw yourself over. That's why, if we refer back to the episode 0 of this series really quickly, I said that my trading strategy was only going to be like my day trading strategy was only going to be like 10 to 15% of the time of this whole series, because it's very simple. It acts under certain rules, and if only certain rules are followed, then the job is taken, the trade is taken. So there's not much to it. You just have to be able to anticipate, speculate, and then kind of have your rule set. So the last thing I wanted to say, was risk to reward, and or stop loss. So this is a little bit more complicated. This is going to be the last thing I talk about in this video. I wasn't going to create its own video on this because, it's just not really like extremely important. Because we'll be getting into that more into the trading strategy, what our exact risk to reward and stop loss will be. But just understanding what a stop loss is and what risk to reward is. So if I were to enter this trade on this Wednesday, on February 28th, and I entered right here, where would my stop loss be? It would be right below this current support and demand. So if we got a candle close below this level, then I would know that with, hypothetically speaking, let's see, we closed right here. This is where the candle was instead of this one. Then this would now be resistance or supply. So the whole thing flipped around 180. We're not looking to bounce anymore. We're looking to farther more reject and go down, because we're not in that box. We're not in this box anymore. We're now into this box. So we're in a different area. We're in a different kind of mode. We're not trading as expected. So that's just another thing to go along with the rule set. If you don't get what you're planning to get, then get the hell out when the chart develops. So that's like your overall idea of a stop loss. You just put it on the other side of wherever you currently are. ideally you're taking a trade at either the top or the bottom. So that way, if it does hit your stop loss, if it does have a daily candle close below or above one of the levels, then you could just get out for not that big of a loss. And furthermore, that would also calculate your risk to reward. So for this setup, we had a 7% gain for a 1% loss. So that's just a quick, it's kind of hard to explain risk to reward, but you're looking to gain this much while you're only risking this much. So just understand, if you put yourself at the edges, at the top and the bottom of the boxes, at the support and the resistance, at the supply and the demand of the boxes, you're giving yourself the best risk to reward. So we always want to trade at the top and the bottom. Now, I can't talk about retests right now because that's just going to be more of a trading strategy video when we dive into the trading strategy. But you can also optimize your risk to reward even more by entering on the retest. So a retest is when you just break above something and you attack it from that level right here. That would be the retest. So on this one, this would be the retest. I'm not going to dive really into that, but yeah, that's just the retest if you wanted to know that. So that'll farther increase your risk to reward and allow you to get that good stop loss, so you don't lose a lot of money and you can possibly gain a lot. Now that's basically everything I had to say. Hopefully you're able to understand, just by me showing a few examples today, that here's another example I can show today. That you can give yourself a possibility of catching the rocket ship. You can catch the larger sack of the move. There's not much more I wanted to say than that, because I don't want to get you too excited and having you enter trades on the 5-minute time frame or the 1-minute time frame when you watch this video and going on the charts the next day. But just understand that if you have patience and you wait for the boxes to develop and you wait for the A+ setups, then you can eventually catch the rocket. So yeah, that's about all I really wanted to say. Really just a super educational video on this one. Not too much to talk about philosophically. Just basically just simplify it as much as you can for yourself. There's no reason to not be able to say screw the overall support and demand and supply and resistance jibber jabber that's constantly being talked about, and just put yourself with the simple box method. So hopefully that makes sense. And if you're gonna learn anything from today, just understand to simplify it all, and you'll be much better off on the other side. So I hope this made sense. I hope this is digestible. If you have any questions, leave them in the comments or DM me on Discord, and I'll get back to you as soon as possible. As always, stay happy, my friends. Peace.